Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. All right, so last week, major US indices did manage to finish actually up on the week. So S&P and Nasdaq up 1.5% and 6%. Obviously, tech was leading the way. Those large mega cap tech names benefiting from the lower rates and a bit of a flight to safety type dynamic. Mid caps were still weak though, down 2.5%, and then Europe had a wake up call. So Europe really taking the brunt, anywhere between sort of 4 and 5.5%. Eurostoxx DAX FTSE. FTSE actually worst hit as commodity sectors really come under pressure and financials, and it's got heavy weightings in those. Obviously, the Credit Suisse news, the banking stress spilling over to Credit Suisse was really what got Europe kind of scared and worried. European bank index was down very, very sharply. And over the weekend, UBS has taken them over, obviously with a bit of arm twisting from the SMB, who are providing a load of liquidity to UBS as well. So just to prevent a bit of a systemic collapse there, we knew something was going to happen over the weekend, and it looks like it's happened in the form of UBS taking over. Gold obviously exploding higher. We saw 2 sigma moves in gold and silver, which is 5.5% and 10% there. Oil got hammered, down 12% on the week, really struggling with the idea that a recession is coming quick, and oil demand's going to potentially collapse, and we have still got inventories building. So OPEC might have to step in somewhere to prevent this, because right now technically oil looks horrible. So hard to really see when that's going to go back into an uptrend, but really starting to take out some levels on the downside, and even XLE having a tough time, down about 5% on the week as well. Vol wise, obviously vol's higher. Really the weekly move in vol was huge here in Europe. 7 vols, 6 to 7 vols higher. So European vols repricing dramatically. It's taking Eurostoxx vol above S&P vol, which is something we haven't seen since the Ukraine war kicked off. So interesting to see that. And then VIX vols are really high as well, around 120. Again, 1 year highs on that vol of vol there. Commodity vols also jacking up, 14 vols in oil. That's massive. Gold up 6. So really these things reaching heights that we haven't seen in quite some time in commodities. In terms of skew, we did see European skew go higher into the 80th percentiles there. Obviously, people worried about what was going to come out over Credit Suisse, taking skew dramatically up into the weekend there. But all these skews are pretty inflated now, and suggesting now that quite a lot of tail risk to the downside has been priced in. We are seeing obviously policymakers panicking. We are seeing, bailouts, backstops, takeouts, all those sort of things happening. So I'd like to think we're getting close to the point where, at least tactically, where a lot is priced in and some kind of relief rally may be able to materialize. If we look back at when Bear Stearns got taken over by JP Morgan back in 2007, 2008, I think that was March it happened. And then the real crisis didn't happen for another 6 months. And we actually got a relief rally into the summer, right? So those are the type of things that can happen, even if the news isn't good, even if everything isn't shaken out yet. Bear in mind that tactical relief rallies can happen when conditions get oversold and when a lot of this tail risk gets priced into markets. Okay, so just something to be aware of. And then the other interesting thing to mention on skew was we got this large move down in precious metal skew, i.e. calls going massively bid against puts. So these are all flipped negative now, where gold skew is 4 vols for calls, silver's 5 vols for calls, taking it to the other extreme. And then if you look at the likes of oil, that went the other way in the 93rd percentile, and the likes of nat gas that's been here for a while, but even uranium now very well bid. So you've got energy skew, cyclical type commodities going bid for puts, but then precious metal skew going the other way, getting bid for calls. So quite a big dispersion there in terms of what the tail pricing is across the commodity complex. Okay, so what else are we looking at? So we mentioned, S&P's been relatively resilient because of that tech rotation. So NASDAQ really outperforming there. If you look at the Russell versus the NASDAQ, you can really see the massive divergence. Huge spike in that spread, around 16% in next to no time, in a couple of weeks. And it's approaching this big resistance zone that's kind of been intact. So, has the NASDAQ kind of run a little bit too far? I guess we'll find out after Powell. Microsoft launched ChatGPT 4. Which they're calling Copilot as part of their Microsoft Office suite. This could be massively game-changing longer term. Their stock is obviously starting to reflect that this stuff's going to take off. but basically a massive productivity boost across the world. 1.2 billion people use Microsoft Office. And a lot of those people might be put out of a job because of how powerful this Copilot thing is, right? So something to keep an eye on. But the AI revolution is very much going on, and we need to be aware of what's happening there. Okay, so and then pain-wise, obviously we said that where the pain was in the various sectors, and it led to, despite First Republic being kind of bailed out by the large banks, Credit Suisse being taken out by UBS, policymakers are panicking a bit. The rates market's obviously pricing it in. They still think we're going to get 25 bips, but Powell's basically going to tell us what the projections are going forward and what the risks to growth are from the FOMC's perspective, and then the market's going to either cheer that or not, I guess. Now, BNP does highlight, though, even if you get rate cuts and we do get a pivot into the summer, that's not always good for equities, right? So historically, cuts have actually happened before the recession has started and before the bottom in the market, right? So that's what their data is showing us, that, the recession, you get your first rate cut, then you get your recession not too far starting, but then markets still have a lot of further downside potential before we see a bottom. Okay, so any rallies, any tactical rallies that you want to play through long exposures right now because you think Powell's going to confirm the cuts, or at least that they've stopped the hiking cycle for now and they're going to wait for more data and wait for more news. If we do get a relief rally to 4,100 on the S&P, that's a rental, right? That is not a structural reason to be bullish longer term based on history, I would say. And like I say, I think really tech stocks are the ones you want to feel probably more comfortable owning. The likes of Apple, that's going to be your kind of safe haven. The likes of Microsoft with this innovation now in AI space, maybe they're the names that you want to park yourself in, but other parts of the market have still got a lot to deal with. Okay. Now on that point, if we look at fixed strike volatility on the week, S&P was up 1.5%, but look at vols. Normally when S&P's up, you should see a load of red and you see vols getting marked down. We saw a massive wave of green, particularly to the downside, which means skew's been going bid as well, despite spot rallying, right? So it's telling you that under the hood, options markets are pricing in a lot of risk, a lot of tail to the downside, despite S&P managing to have some gains last week, right? Now, what does this say to me? It says to me that there's a lot of stress still priced into the curve. And if Powell can give us any kind of words of comfort whatsoever, this vol can come down quite a lot. And that is your Vanna fuel, which can provide a bit of an uplift to the market into maybe the end of March, maybe even sort of into Easter time, right? So there's a lot of room for vols to reprice down and markets to get a relief rally from that repricing if the FOMC is an event that takes vol out of the market, right? If you can give us some reassurance, if you can give the market comfort in what the rate path might look like and what the Fed's views are on all this nonsense that's happened in the last few weeks, then there might be a vol reset coming. And we know that tends to be supportive for markets, okay? Now, another way of playing for stabilization might be look at the financials. They've obviously been beaten up the most. This is XLF. XLF dropped from like 36 to 31 in short order. If you wanted to play a bounce in that, what would be the way to do it? I would generally, looking at a vol dashboard, obviously selling puts is screaming out as the trade here. Way too dangerous for me. Even if you think this stuff's expensive, skew's blown out, selling puts, the front of the curve is expensive. Selling short dated puts is obviously the thing with the most juice, but it's also the thing with the most risk, and you don't want to catch a falling knife. So I prefer to land on put spreads, just because we know what our risk is. We know it's not going to blow up in our face too badly. Lots going on in markets right now in terms of volatility, so there's a lot to talk about. All right, thanks for listening. Catch you all tomorrow. Cheers.